Today, let's delve into a topic that no one really wants to ponder. What could actually shut down the stock market? The systems in place are far more fragile than the common buy every dip mantra suggests. First, consider a bank run. If just 2 to 3 major banks experience liquidity issues, panic could spread instantly. It's crucial to remember that banks don't typically hold all your deposits. In the face of rising fear, withdrawals might freeze. Next, a bond market shock poses a threat. Should U.S. Treasury yields spike beyond 6% or 7%, a significant stock crash could follow. This scenario creates havoc across corporate debt, mortgages, and credit markets. Interest rate breakage is another risk. Should inflation surprises force the Fed to hike rates again, the much-desired soft landing could transform into a harsh crash landing. Tariff shocks, especially between economic giants like the U.S. and China, might abruptly halt global trade flows. This can devastate supply chains and crush corporate profits. Beyond these, an oil price explosion due to Middle East tensions could send prices surging past $150 per barrel overnight, significantly impacting transportation, manufacturing, and energy costs. Numerous other factors exist, such as geopolitical cyber attacks, major corporate bankruptcies, derivatives unwinding, liquidity gaps in overnight trading, sovereign debt crises, political paralysis, and natural disasters in financial hubs. Each holds potential to send markets into disarray. While calm may prevail superficially, there are countless ways to destabilize the fragile system with only one delicate path to maintaining order. Market circuit breakers exist for a reason, with pauses at 7%, 13%, and a total shutdown at a 20% drop, underscoring the potential for rapid downturns. Remember, sometimes the wisest choice isn't intensifying efforts, but waiting it out. Protect capital, stay patient, and move strategically when others are paralyzed by fear. This is Dealmaker's Den, a place where we don't just survive volatility, but thrive because of it.